Joining me now is Dan Clifton. He is head of policy research at Strategic Securities, a Baird company. All right, Dan, it's good to have you. And let's not, over litigate what should have happened, but to take the sort of conclusions and say what needs to be done right now.
That's absolutely right, Kelly. If you think about it, the Fed's job is hard enough. They were behind the ball. We've made some serious policy errors. You mentioned the spending. I would also argue that we've had no change in energy policy since the Russia-Ukraine attack, even though we knew oil prices would go up if that attack hit. And we're starting to see more and more pressure in the energy and the food markets itself, which are going to further make the Fed's job harder. As we start to think about what could happen moving forward, there are very active negotiations happening today. In fact, there was a meeting in the White House with the president yesterday about potentially raising taxes and paying for more renewable energy spending that won't hit until 2025 or 2026. And if you think about where economic growth is today, it's probably going to be negative in the first half of this year with that high inflation. And so we're getting a lot more spinach, or the possibility of more spinach, and that could be a potential policy error. We should really be looking at ways that we can start to increase production of oil and gas, distribute it better, and as well as being the support system for our friends in Europe by removing the caps for NATO countries to receive LNG exports from the United States. All of that will help. But when I look at the headlines over the last 2 days, you have the president's letter to the oil companies, possibly implicating price controls or something on energy, which will be a policy error, the opposite effect. And we're still having serious talks about some Build Back Smaller, which is a lot of tax increases up front at a time when companies and individuals do not have the resources to pay those taxes.
Ironically, the one thing that it could all result in is to slow the economy enough to bring down inflation. So in an odd way, it's pointing in the same direction as the Fed, if that's now the primary goal. It's just that it might set us up for a situation in which we have more stagflation and a less productive economy over the ensuing, 10 or 15 years.
Well, that's absolutely correct, Kelly, right? And so I want to be careful here that slower growth does not necessarily mean slower inflation. In 1968, where there's enormous parallels to where we are today, we raised corporate and individual income taxes to slow inflation down. And what we got was the complete opposite. We got the slow growth, but we didn't get the inflation down. In fact, inflation accelerated. In 1993, Alan Greenspan and Bill Clinton said if we raise taxes, the Fed wouldn't have to raise rates as much. And as you know, in 1994, we had a furious raising Federal Reserve, including a 75 bips Fed funds rate increase after that tax increase was enacted. So that slower growth doesn't always result in lower inflation. And we need to be very careful about those policy decisions that we need to make. The big takeaway from this is that the monetary framework and the fiscal framework that we've been using for 40 years has been completely upended this year. And you're throwing this kind of geopolitical challenges on top of it. It is important to figure out what the problem is and get that solution correct, rather than going into these policy error, begetting policy error, begetting policy error. In that respect, that's what led to the problems in the 70s and the risks we have if we make mistakes here.